Good morning, everyone. Uh, Sorry for how long this has taken. I had done a lot of extensive back testing and research to get to this point, and I wasn't gonna give you something that I wasn't even sure of, but that's no longer the case. So, yeah, I'm ready. That being said, this is also my first time doing this. I'm not a YouTuber or teacher, so if I do make a mistake, say something wrong, I apologize and I will try to correct myself when I can and, fix my errors. But that being said, today's video is about market structure. Market structure is the base, it's the bread to the butter. Oh, yeah, the bread to the butter, you could call it. It's where everything originates from, it's where everything stems from. You need market structure to know how to trade. Reason being is because market structure tells you bias, it tells you direction, and if you know the bias and the direction, well, then you're able to get involved in trades that are on the correct side. I'm sure a lot of you, if you're already into trading, know all about market structure, higher highs, higher lows, lower highs, all that jazz. But for those of you who don't, I will explain. And for those of you who do, hopefully I have something new I can teach you that you maybe didn't think of before and can make your trading a bit easier. But that being said, I'm going to get right into it. This is going to be a one-take video, so let's run it. Okay, on the left we have a bullish market. On the right we have a bearish market. A bullish market consists simply of, first off, a high being established, followed by a low, followed then by a higher high, followed then by a higher low. Okay, reason this is a higher high is because this high is higher than that high. Reason this is a higher low is because this low is higher than that low. Okay, and so it continues. We get a higher high, higher low, higher high, higher low, higher high, higher low, so on and so forth. Bearish market, exact same concept, just reversed. Okay, a bearish market will start off with a low, followed by a high, followed then by a lower low, followed then by a lower high. Reason this is a lower low is because this low is lower than that low. Reason this is a lower high is because that high is lower than this high. And so it continues, lower low, lower high, lower low, lower high, lower low, lower high, so on and so forth. Okay. Now, the main thing that makes market structure so important is the expectation it creates. Okay, it also shows you direction, which you need to know direction, because if you don't know where to go, you don't know whether to buy or to sell. Okay, but the expectation it creates is something known as expectational order flow. It is one of the reasons why I'm not very fond of trying to trade pullbacks, counter trend pullbacks. Some people will be trying to buy the high so they can catch it back in here so that they can go long again, just back and forth, back and forth. I'm not very fond of that. I'd rather just stick to a market's bias and trade it one way. So, for example, this market, I'd just be going long. I'd just be taking buys the whole time. A sell wouldn't even occur to me. Okay, so now back to expectational order flow. What expectational order flow entails is that a story is created. The story is that once this high is taken out by this high, this low then becomes a protected low. What that means is, for the future, this low is expected to hold and continue to take price higher, making this the then targeted high, where price will want to take out sell stops and liquidate it to continue pushing up higher. That is why I have TH and PL marked out. So we'd have a high put in place, followed by a protected low. Expectation is that this low will hold and we will be able to find buys from this low. Okay, once we then get the pullback into, let's say, a demand zone, you then expect that this high is the one that's targeted, and price isn't going to want to go anywhere near this low, but instead it's almost like a magnet going to be gravitated to taking out the liquidation, or the liquidity, at this high. And it'll go targeted high, protected low. It'll be protected low, targeted high. We then get a low. That low then takes out this high. So now this becomes a new protected low. Then get a low. Okay, this now becomes the targeted high. This high gets taken out. Now this becomes the protected low, so on and so forth. Okay, again, on the bearish side of things, exact same concept, just in reversed. Instead of a targeted high, we now get a targeted low, and instead of a protected low, we now get a protected high. Okay, so again, the expectation is that once this low is taken out, this becomes the protected high. Price then pulls back, taps into some sort of supply, and again, like a magnet, is gravitated towards taking out the liquidity from this low. The reason this was such a game changer for me is because it brought my confidence to another level. Knowing that this high is more likely to hold and this low is more likely to get taken out allowed me to really be confident in actually taking positions and watching them ride out and taking the liquidity at these lows. Once market structure is established, this is the expectation that you have based around it. Okay, and how you would use this, I'll get into entries and all that, but how you would use this simply to actually take trades is, let's say there is I'll do this, let's say there is a supply here. Obviously in this bearish market you would be looking to take sells. Let's say there's some form of supply. You now understand that you have a low that was taken out, so now this becomes a targeted low, and now this becomes a protected high. You understand that, okay, I'm going to look for some supply to go short from, short meaning sell. You then look for whatever you look for, order block, supply zone, and you place your order. And because you now have the expectation that this is the low that will be taken out, you can then start to use that as your target. And every time price breaks lower and lower, you now have new areas to look for both entries and exits from your trade. Same exact thing with the bullish side. You'll then have these expectations that if this low is protected, I want to target this high. The moment that high gets taken out, I know liquidity has been taken out and I can close my position. Wait for the next, protected low and targeted high to be created, and you just continue moving up and up and up. This was a big game changer for me, understanding expectational order flow and having the anticipation that this is the low or this is the high that will be targeted. Now, a big thing that I struggled with was knowing when a low or a high is actually put in place. What I mean by that is knowing what separates this low from being a low and maybe a different looking low from being a low. And where everything in that aspect changed for me was when I found out about the pullback rule. I got these diagrams drawn up here. I'm going to show all of you this on the chart as well. But the pullback rule essentially is the criteria that needs to be met in order for a low or a high to be valid. Okay, and what it looks like is on the left I have an invalid pullback rule, and on the right I have a valid pullback rule. Okay, an invalid pullback rule consists of when this is obviously in a bullish trending market, so we'd have a low, higher, or we'd have a low, a high, then we'd have a no, sorry, I apologize. We'd have a high, we'd have a low, then we'd have a higher high, then we'd have a higher low, and then we'd have a higher high. Okay, so now obviously because of expectational order flow, our expectation again is that price is going to pull down, tap into some demand. This is another protected low. It's going to tap into some demand and then take out the newly established targeted high. But the only reason you know this is a high is because of the pullback rule that is put in place. Okay, so what the pullback rule looks like is essentially, I'll show you what the correct drawing looks like and then the incorrect. A pullback rule is when the previous bullish candle has a bearish body close below the wick. The moment you see this on a chart after a high is taken out, you understand that a new high has been established. So this is a valid pullback rule, bullish in a bullish trending market. This is an invalid. You can see the difference lies in the wick. Here you can see price pushed down, try to take out the wick got absorbed, price then pushed back up and closed within that bullish candle. This does not count as a pullback. This counts as a pullback. Same exact example with the bearish side. We'd have a low, we'd have a high, we'd have a lower low, and then we'd have a lower high. Again, expectation is that this is now the protected high. So the expectation is price will pull up, tap into some form of supply, and target that newly established low. But how do you know it's a low? Because again of the pullback rule. I'll show you what the correct one looks like first. Valid pullback rule. The previous bearish candle has a bullish body close above it. Again, this is what establishes basically a new low in the market, okay, for the bearish side. So the low would now be here, and if price was to come down and break that low, this would now be your new protected high, and just for example, this would be your demand level that you then look to go short from, or your supply level, I apologize, that you then look to go short from. Okay, I will show this all on the chart as well, but here's a correct pullback on a bearish trending market. So this is a new low being put in place, and then here's the incorrect version. Again, all that happens is this wick candle pushes up, takes the wick, gets liquidated, pulls back in, and doesn't have a body close above it. I will make a diagram and send it to the group so that anytime you get confused or want to look at the pullback rule, you can see it. So what I'm going to do is I'm going to jump right into showing you what that looks like on the chart. Okay, I will go just to an hourly chart so that it looks nice and clean. And here we go. So this market, let's see where I can start if that looks nice and clean. Okay, you know what? I'll start off right here. So in this market, we have a, sorry, let me go a bit left. There we go. We have, this is going to be a market that changes. We have a high, then we have a low. The reason this is a low is because, again, pullback rule. So I apologize, it isn't the previous, the previous candle doesn't have to be bullish. The previous candle just has to have a body close on the next candle below it. So for example, valid pullback rule. So now the moment this happens, this high right here is now established as the targeted high, and price can come and take it out. So we have a high, we have a low, we then have a break of this high, which then again establishes a new high followed by a new low. Why is that a valid low? Because look to the left, here's a perfect example of a fake pullback rule, or not even a pullback rule. You can see we have that candle, price tries to push below it, fails, comes back up and closes within it. Then on the next candle, we can see price then comes down, closes below it, and now we have a newly established low. And every time that low is taken out, it moves. So again, low's taken out, it moves. This now stays the low. We can see this is now the lowest low. Price then takes out this again. That becomes a low, and then that becomes a low. Reason being is because of the pullback rule there. So every time a new pullback rule occurs and price pushes lower, the low goes lower. Okay, so now this is a bullish example. So we'll have again the high, the low, higher high, followed then by the higher low, followed then by the higher high. All right, followed then by break of this low. Okay, so now we're potentially switching bearish. We get that low there, then we get that high there, followed then by that low there, and now we have a high and we have a low. To show you what a bearish pullback rule looks like, it looks exactly like this. So here we'd have a break of this low, then we'd be waiting for the pullback rule, no pullback rule, no pullback rule, no pullback rule, sorry, boom, right there. Why? Because the previous candles, or this candle, closed above with a body close the previous candle's high. So now this right here becomes a newly established high. Then when this candle closes above it, this now becomes the newly established high, so on and so forth. Price wicks, 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 wicks. A high technically moves up to here because of all this absorption, but all you need to know is that once this happens, a low is established. As you can see, this would be the targeted low, and this would be the protected high. Reason being is because this high took out this low. We then get that pullback. Pullback rule then establishes a brand new low has been put in place. Expectational order flow tells us that this low will be taken out, and lo and behold, it gets taken out, liquidated. So there wouldn't be any position here for me, but I'll explain that in a future video as to why. So that's basically the general idea of the pullback rule, but just so that I can show those who don't know what market structure looks like, I will show you on the charts, and I will keep doing so with using the pullback rule. So here again we have, it was this high followed by this, followed by this low, followed by this high. So this high took out this low, and there's an interesting reason as to why price didn't hold this demand, but I'll get into that in a later video. So then from there we get the high, we get the low, we get the high, we get the low. Okay, price is now stuck between this high and this low. So expectation is for price to go bearish. So expectation order flow, high, low, this high took out this low right here. So expectation again that this is the protected high. This high won't be taken out. It didn't get taken out, it only got liquidated. And this low will be taken out. It also didn't get taken out technically, it got liquidated, but as a target it was hit. We then follow price. All right, we then get a break of this high. So let me mark it out in green. We then get a break of this high. Price then goes high, low. Reason that's a low, valid pullback rule, body close below the previous candle. So now the moment that happens, it's established as the new low. Once again, we get a break. So we have high, we have high, low. We then get a higher high. Okay, we then get a higher low. Reason again being pullback rule. On this candle here, this tiny little doji candle here, you won't even be able to see it when I mark it. But there's the pullback rule. Previous candle has a body close below it. So now once this low is established, guess where the target is? This high right here. High gets taken out. Again, what do we see? New high established right here. Why? Because body close below the previous candle's low. So now again, that is now a valid high that's been put in place. And as you can see, we have, remember, the protected low. Protected low creates a new high. Price comes down, tests this zone. Expectational order flow tells that this is the protected low, this is the targeted high. So price should take out this high. And what does price do? Takes out the high. Interesting thing here, is this a valid high that's being put in place? No, it's not, because price pulls down, wicks the previous candle's wick, pulls back up and closes it inside. So this is not a valid low. So now we have low, high. We have a low here because this low is responsible for taking out this high. Price continues. We then get a brand new high up here. Reason being, clear as day, valid pullback rule, body close below the previous candle's wick. Again, expectational order flow tells us that this is the targeted high. This is now the protected low. Price then, again, after making the low, pushes up and takes out the high. Okay, and now on Friday we can clearly see, what can we clearly see? No, we even had another push up. We had this high, followed by higher low, followed by break up, followed by a new high put in place. Why was that high put in place? Because again, valid pullback rule right here. Boom. Valid pullback rule right there. This high, of course, gets targeted. High gets taken out. But at the same time that high gets taken out, so does the low. Just like that. So that is the basics of expectational order flow and the pullback rule. That is what differentiates some areas where people might think is a pullback. Some people would think this is a pullback. That's not a pullback for me. Some people would think this is a pullback. That's not a pullback for me. Okay. The pullback rule is what allows you to then establish the new high that's going to be targeted. This high wouldn't have been targeted, or we wouldn't know it's a targeted high until we saw a valid pullback rule get in place. The moment you saw that, you know that's a valid high, and now we can start looking for longs to take out the targeted high. Okay, same with this low. You have no idea this is a targeted high until price follows through with the pullback rule, again comes into some form of demand, and our expectation again is that this is the protected low, this is the targeted high, buys, 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 take out the high, and it's so on, so forth. And again, looking at what trades would look like, you'd find, let's say you'd find a demand zone in here. You'd then aim for taking out the targeted high, and that would be you done, basically. Anything further than that, you'd have no idea where target was, because expectational order flow tells you that this is where liquidity is resting, and this is where you want to take your profit, because anything else other than here is just empty price action, and you don't know what could occur. But those are the basics, and that is the basics of the pullback rule, at least in a bullish market. I will quickly scroll back and let's see if I can find you a bearish market. Perfect. So there is more that goes into the way I view market structure, but just for this video, I'm going to go over the basics. The next video, I will run through MBs, and what MBs allows you to do is to tell when the market is in what I like to call redistribution and reaccumulation. It's essentially when the market goes bearish to go bullish again. That's reaccumulation, and redistribution is when the market goes bullish to go bearish again. It essentially reaccumulates orders and shoots back up, and redistribution redistributes orders and comes back down. But I'll get into that when I get into MBs in the next video, because that's very in depth. But again, just for market structure and the basic pullback rule, we have a high. Well, I'll start here. We have a high, we have a low, we have a higher high. Okay, we then have a lower low. The lower low is first again put in here, but you can clearly see that this high doesn't get taken out, so price keeps pushing down lower. This is now the new lower high, because why? Oh, sorry, this is the new higher low. Apologize. Why? Because this high gets taken out right here. Boom. Then eventually we start to get a breakdown of price. Price now takes out that low. Expectational order flow, that break came from this high. So this high created this low. Why was that a valid low? Because pullback rule right here. Body close above the previous candle's high, at least the wick. Again, we have the protected high, we have the targeted low. Lo and behold, price comes for the targeted low. Once the targeted low is taken out, we now have established a new high, followed by establishing a new low. Again, why is it a low? Valid pullback rule where? Not here, that's a wick. Right here. Why? Again, body close above the previous candle's high. Okay. Then from there, we get the high, the protected high that holds, and we get the targeted low that gets what? Taken out. Again, valid low. Why is it a valid low? Simple pullback rule. This then becomes the targeted low. Price then targets it, takes it out. Okay, here is there a valid pullback rule? No, there's not, because all we have is a wick. followed by a wick, again followed by another wick, tiniest break over there, as you can see. But that's not a valid pullback, so this wouldn't be my targeted low. I wouldn't be looking for new trades yet because this isn't a valid targeted low. When does the new targeted low get put in? Boom, right over here. Valid low. Why? All of this again is just wick after wick after wick after wick. Only here do we see a body close above the previous candle's wick. Again, this now becomes the targeted low. Price then comes down, takes out the low. Where is the high? The high was established here. So now this is the protected high. Clear as day. Even if you're just simple supply and demand trader, this is literally a valid supply. I'll change the. Let me change this for you so you can see it better. Literally simple day trading, simple supply and demand trader. Where is the new established targeted low? The new established targeted low would be here. Because why? Body close above the previous candle's wick. This is now the targeted low. Price comes in, mitigates the supply. You could have had an order here. Boom, boom. This gets taken out. Targeted low again, gone. And again, the high updates right back to here. Low updates down to here. Low gets taken out. Why is that the new low? Because again, body close above the previous candle. Okay, this candle doesn't have a wick, but that doesn't matter at all. Okay, low gets taken out, and then from here, this would be a prime example of a redistribution. We have a break of this high. Okay, a lot of people would start going bullish, and you could go bullish. Technically, you could have gone bullish at this level right here. Reason being is because we had the low, we had the lower low, then we had the higher low, then we had the lower low, then we had this break of that lower high, so that's technically a bullish break. From there, price would then tap into the supply, and this demand, apologize, and then go long. Okay, but reason it's a redistribution is because you can see it only went bullish to go bearish again, and there would have been valid supplies and valid shorts in this area once you understand, obviously, redistribution. As I said in the next video, I'll get into that. Okay, but once again, we have the break over there. So we have the lower high, lower low, then we have the high, then we have the low. Reason that's a valid low, again, because pullback rule. So what does this high become? This high then becomes targeted. Targeted high gets taken out. We then have valid low. From that valid low, what do we now have? Targeted high. High gets taken out. We then get a breakdown of price. Price then takes out the low. So now we have established a new high over there. All right. Price then establishes a new low right here because there's the body close. Oh, actually, I'm wrong. Over here, there's the body close. We get the pullback rule. All of this was just wicks, wicks, wicks. So guess what? This becomes a targeted low. And this now becomes the protected high. So you can see in the beginning it may be a bit tricky to see. You really have to pay attention in the beginning. I suggest that anyone who wants to learn this rule really goes back and just looks at the chart and starts marking out highs, lows, and noticing the pullback rule and marking out the ranges so you can see exactly what high and low you're playing between. That way you'll be able to notice and mark out the protected highs and the targeted lows in a bearish market, and then the targeted highs and the protected lows in a bullish market. But honestly, I think is that all there is for market structure. Yeah, market structure, that's all there is. In the next video, I will go over ment blocks, and yeah, I'll go over ment blocks because ment blocks adds a whole new level of understanding to market structure, as well as I'll go over accumulation, distribution, reaccumulation, and redistribution. and that'll just add another layer into understanding true market direction and not getting caught in thinking that this break of the low, like right here, this break of a low, yes, it didn't even send the market bearish. Here this market was choppy because we had this low get broken. Sorry, so we have the low, we have the high, and we have the low, but then that high just gets taken out. So now we're just in a choppy market going back and forth, and then from there we get this low get taken out right there, and then again it does go bearish for the shortest amount of time, but right after that we get that high get taken out and price just starts to push bullish again. So understanding reaccumulation and redistribution is going to help you a lot in understanding the market's direction even when it looks like it's going bearish, because what people like to say is when you think it's going bearish, it's going bullish, and that couldn't be further from the truth. Or sorry, it couldn't be closer to the truth. I apologize, because just because you see market structure starting to break down once or twice doesn't mean the market is actually going bearish, and vice versa for bullish. But yeah, that is all there is to market structure for now. The most important thing is the pullback rule, and it is just understanding higher highs and higher lows, and understanding why it's a higher high and why it's a higher low, or why it's a lower low and why it's a lower high, and that comes from understanding the pullback rule. The moment you understand the pullback rule, then you'll be able to differentiate between real highs and real lows, and you'll know exactly where the expectation or order flow is going. But yeah, that's all I will do for today. I hope you enjoyed that video. I hope I didn't waffle too much. I hope I didn't get lost too much and you're actually able to understand what I was saying. But again, it's my first time doing this and I'll get better with time. But yeah, I will send a diagram of the pullback rule. I'll send this exact diagram. I'll just fix it up. And yeah, I hope you guys enjoyed that video, and I hope you learned something for market structure. And next video again will be on reaccumulation, redistribution, accumulation, distribution, and ment blocks. And yeah, that's all I have to say. I hope the wait was worth it. I hope you guys had some light bulb moments. I hope I explained it well enough. And other than that, enjoy the rest of your day. Take time to look at the markets and actually practice what I just taught you here, and be able to train your eye to see it yourself, on a whim. And other than that, thanks for watching, and I will see you when I make the next video. Any questions, you can just drop them in the chat, and I'll be more than happy to answer. Cheers.